Hello and welcome to the latest episode of On the Money, a weekly bite-sized show that covers investment topics and also occasionally delves into wider personal finance subjects. Today it's over to you as the episode contains questions that have been submitted by our listeners. Now, to get in touch with questions for a future episode, or if you've got any thoughts on investment topics that you'd like us to cover, or any suggestions for who you would like me to interview, then please drop us an email on otm@ii.co.uk. Joining me today to help tackle your questions is Craig Rickman, Personal Finance Editor at Interactive Investor. So Craig, we've had some questions related to pensions, and given that is one of your mastermind subjects, that's why I was keen to draft you in today to help.
Yeah, my pleasure. Fortunately, unlike Mastermind, the answers here aren't quick fire. But I did have a think about what my Mastermind subject would be. I had a think recently. Not that I have any plans to apply, but I think, maybe something to do with Southampton Football Club in the mid-1990s.
Well, I think the thing is, Craig, if you got through, then you'd have pensions then in your pocket for the quarterfinal.
Absolutely, yeah, good point.
So let's test your knowledge. So first question from Robert asks whether we will see changes to the pension landscape under the new pension minister, who is Torsten Bell. Now, Craig, this is a big topic. I suppose to start off with, could you explain Bell's background and why this influenced why he was chosen?
Sure, yeah. Let's have a sort of a quick glance at his CV. So he's a former CEO at the Resolution Foundation, a think tank. We'll discuss a bit more about his time there in a bit. He's also worked in the Treasury. He was a special advisor to Alistair Darling during the 2008 global financial crisis, and was also a director of policy to former Labour leader Ed Miliband. So that's his background. So in terms of changes, well, he's certainly got a big job on his hands to try and whip the UK retirement landscape into better shape. I guess one of the first tasks is to take the baton from Emma Reynolds and spearhead the pensions review that Labour launched last year. There's also a pensions adequacy review, which will put auto-enrolment contributions under the microscope, namely sort of weighing up whether they should be increased. So this review was shelved in December. This is before Bell started, but will inevitably land on his lap at some point. There's also the pensions dashboard project, which is sort of planned to be up to speed by next year. So yeah, he's got a lot on his plate. There's a lot for him to get his teeth into. It's also probably worth sort of having a look at some of his prior views on not just the pension system, but some aspects of savings as well. These have been sort of well documented, and you could certainly describe some of them as radical. We'll start with the triple lock. So he's said that he's not a huge fan of that policy. We're unlikely to see any changes within this parliament with the state pension triple lock for a couple of reasons, I guess. One is that Labour is committed to the policy, or committed to it in its election manifesto. And the other, that now they've sort of started means testing winter fuel payments. So any changes to the state pension triple lock are very unlikely for this parliament. In terms of his other views, so during his time at the Resolution Foundation, he advocated for a flat rate of upfront pension tax relief, and interestingly, a lower cap on maximum tax-free cash. And we know that if that were to be implemented, how that would go down. So he's had some big ideas around the pension system in the past, but whether there'll be any big changes to pension tax or any more big changes. We had the big decision around pensions and IHT at the autumn budget. So it seems unlikely that we're going to get any other changes to pension tax throughout this parliament. Never say never, and just whether he will actually pursue any of his former views in the short term at least seems unlikely.
Well, I think, there's a big difference between calling for or lobbying for certain changes to happen and then being in government and then implementing them. I mean, some of those changes that when he was at the Resolution Foundation that they lobbied for, they would be quite controversial, to say the least. The Resolution Foundation, when Bell was there and he was the boss of the Resolution Foundation, they also proposed a potential lifetime cap on ISA contributions at £100,000. Do you think, like the other proposals, Craig, that this is very unlikely to actually see the light of day?
Yeah, I think that's unlikely. I think it's something that we wouldn't want to see either. having a lifetime cap on what you can pay into ISAs. I think we want to, try and encourage people to save more for their futures, and a radical policy such as that would undermine confidence in the investment and savings system. So I'd be very surprised if we saw that.
I think something that I think everyone would agree on, it would be great to see a pension minister in their post for a long period of time. I mean, his predecessor, Emma Reynolds, only had the position for 6 months, and Bell is the 8th pension minister since May 2015. I think it's important that there's a consistent figure at the head of the UK's retirement policy, driving positive change. I think that's desperately needed. Craig, let's stick with pensions. We had a question on the inheritance tax changes to pensions that were announced in last October's budget. Now, those changes don't come into force until April 2027. Charles got in touch to ask, how will my offspring be taxed on inherited pensions from April 2027? So this is on unspent inherited pensions. So Craig, over to you.
Yeah, it's a very good question. So there was a consultation on this which was running. It ended last month, a technical consultation on how things will work. We're waiting for the outcomes of that. But in the meantime, if we sort of address the proposals in their current form, these could change over time, or certainly between now and April 27. I mean, if there are going to be any changes to this, we'd hopefully find out about them sooner rather than later. So under the current proposal, any unspent, as you say, pension monies will be added to other assets and could be taxed at 40%, which is the current rate of inheritance tax. That doesn't mean pension savings will be taxed. So anything left to a spouse or civil partner escapes IHT. I know in this instance we're looking at sort of beyond that. So when it goes down to younger generations, but that exemption remains. But if the amount of pension when added to other assets is below your lifetime tax-free threshold, then they won't be taxed. So, and for some people, if you're married or in civil partnership and you have a home that you intend to leave to your offspring, then your tax-free amount could be up to £1 million. So again, but this is purely the initial proposal. There's been quite a lot of opposition to what's been put forward, because one of the sort of sticking points is this sort of potential double taxation if death occurs after 75. So whoever inherits the pensions may not only pay inheritance tax, but could pay income tax on anything they take out too. Various people have crunched numbers here, and some potential tax rates upwards of 70% have been discussed. So there's been some opposition to this. Several investment platforms, including Interactive Investor and wealth managers too, have lobbied for the government to consider alternatives such as a flat rate of tax. So hopefully soon we'll find out exactly how things will work from April 2027. So that people can plan ahead accordingly, because it's something that people are going to want to do. They're going to want to sort of take stock of this potential change, or else families, offspring particularly, could be lumped with a sizable tax bill.
And what are your thoughts, Craig, on how inheritance tax being applied to pensions will change people's behaviour? So I think there's various ramifications, but I mean, I'd say that I think people will look to gift earlier. That's one thing that will potentially happen. And also, I think some people will spend more of their pension sooner.
Yeah, I think that could happen. I guess that could also be a risk with this policy, that people drain their pensions sooner and either spend the money or gift it away. If pensions are no longer sort of serving or no longer have a function as an IHT swerving sort of or a way to avoid inheritance tax, people will be looking at other ways to either get the money out and either spend it or feed it down the line to younger generations. I do think that this could prompt some changes in behaviour this year. This is something I wrote about towards the end of last year. I think this could accelerate the so-called great wealth transfer, where you've got sort of trillions of pounds passing from older generations to younger ones. Not just the changes to pensions are influencing this. So the IHT reforms or proposed reforms to farms and businesses may impact that too. But I think the thing with this is sort of like I said earlier, the rules are still yet to be rubber stamped, which is important to bear in mind if anyone's looking to hook money out of their pensions. with this change potentially coming down the track, and also be careful, not to spend or gift your money if it means that your retirement lifestyle and comfort is potentially jeopardized.
So that's the pensions questions covered off. And as Craig touched on, he's written lots of articles related to the inheritance tax changes that are going to come into force in a couple of years' time. So do check them out at ii.co.uk. Let's now switch to the investment focus questions that were sent in. John got in touch just a couple of days ago to ask about which funds are best at protecting capital. Now, John didn't mention it in his email, but I'm guessing he got in touch following the tech wobble that played out recently, following the sudden rise of a Chinese artificial intelligence model from DeepSeek. I think firstly, it's worth pointing out that when there is a stock market fall, the first thing to do is not to panic. Instead, it's important to keep a cool head, take a step back, think about the long-term view rather than making any hasty decisions that you may end up regretting. And particularly when it's a stock market that goes through a rough patch, it's important to step back and take the long-term view. Remind yourself that if you look at a 20-year chart of the total returns of, say, the S&P 500 index or the FTSE All-Share index, those dips that occur, they look like a mere footnote in the grand scheme of things. You can hardly see them on a long-term chart due to the power of long-term returns and compound returns as well. However, I do think that the recent tech wobble is an opportunity for investors to question whether they've become overexposed to technology stocks, particularly the world's biggest technology stocks, the so-called Magnificent Seven. US stock markets have become more concentrated due to the share price successes of those 7 companies. So they become a larger and larger part of the S&P 500 index. And while tolerance for market volatility, it's a personal thing, the need to mitigate risk through diversification applies to everyone. And of course, diversification, it involves spreading your investments far and wide, owning a mixture of different assets. And the personalization bit comes in terms of how much risk you're willing to tolerate in terms of allocating between shares and bonds. But to specifically answer your question, in terms of defensive funds, the ones that stand out for me are wealth preservation investment trusts. And the two I'd highlight are capital gearing and personal assets. They both invest in a variety of defensive assets, including index-linked US government bonds and gold. I'd also consider, as part of wiser research, looking at multi-asset funds that are cautiously managed, particularly those that are investing in index funds, such as the Vanguard Life Strategy fund range, for example, or the BlackRock MyMap range. I'd look for funds that have a lower equity content in those ranges. I'd also point out that there are certain investments, even though they've got 100% exposure to global equities, that are more steady eddies. I'd point to Alliance Witten and F&C Investment Trust. These are both highly diversified options. They have more than 200 holdings in the case of Alliance Witten and more than 400 in the case of F&C. They both adopt a multi-manager approach, which means that the investment decisions are outsourced to a number of stock pickers that are investing in different regions and in different sectors. Craig, any further thoughts from yourself on defensive investments and indeed what should be at the forefront of investors' minds when there is a nasty dip?
Yeah, I think you've given a very comprehensive answer there, so not too much to add. But I think it sort of all as a sort of a general investing rule, it's about your sort of purpose for the money, your purpose and your time frame. So within any portfolio, you're going to want some things that are a bit more defensive, particularly if you've got sort of short-term plans for the money, or it's just there to act as a buffer or for emergencies. So I think, and it's understandable to want to take a more defensive approach, with a view that a dip may arrive. But again, we don't know what's going to happen with markets. So, I totally agree with your point about sticking with it, taking a long-term view if you don't need to use that money for, at least 5 years, and diversify. So I think it's all about sticking with the same investing principles no matter what the economic conditions are.
And the next question is linked to the fact that US stock markets have become more concentrated, as I've just mentioned. So Guy got in touch to ask, I'd be interested for an episode that explores the US market, trying to avoid overvalued stocks, but wanting to still be in the market. So he's asked for some ideas, basically, of exposure to the US while keeping a lid on risk in terms of how sizable the technology stocks are in the S&P 500 index. So, as I've mentioned on the podcast before, for investors concerned about US markets potentially becoming too concentrated in terms of exposure to those 7 stocks, the so-called Magnificent Seven, you could consider having some exposure and hedging your bets by looking at an equally weighted index fund or ETF. So given that there's 500 companies in the S&P 500 index, with an equal weighted index, each stock is weighted at 0.2%. So in theory, if there is a broader set of winners in the US markets, then an equal weighted approach will, again, in theory, will capitalise on that more than the more traditional and common market cap weighted indices. And in addition, if technology stocks are overvalued, then you are gaining cheaper exposure to the S&P 500 index, given that the percentage weightings for those 7 stocks are much lower under the equal weighted approach. Now, there's not many options that invest in this way, but 2 on our platform are Invesco S&P 500 equal weight ETF and Xtrackers S&P 500 equal weight ETF. Now, in time, I'd expect there to be more equal weight index funds and ETFs to be launched. And I also wouldn't be surprised if there are some global equal weighted approaches launched in the not too distant future. You could also consider actively managed funds. So most US active funds are actually underweight the Magnificent Seven, meaning they own less than the index. Most of them own at least a couple of the stocks, and if they do own them, then they are typically going to be among the top holdings if they are owned. But given that an active fund is trying to beat the wider market, then they do need to cast their net wider and try and add value by looking at potentially undervalued stocks in order to try and beat the index. Now, last summer, we started a new quarterly report called the II Top 50 Index. So this index ranks the most popular funds, investment trusts, and ETFs each quarter. Now, the reason why I brought it up, as well as giving it a bit of a plug, is because for the 4th quarter of 2024, there were 3 US active funds that entered the top 50, having not previously been in it. So this is a sign that some investors, like Guy who's written in, are looking at potentially different ways to have exposure to the US market. So those 3 funds are Artemis US Smaller Companies, Baillie Gifford American, and JP Morgan American, which is an investment trust. So just a brief summary of these funds. So Artemis US Smaller Companies, it invests in America's innovative, entrepreneurial, and fast-growing smaller companies. Given that smaller businesses typically have greater sensitivity and more revenue exposure to the domestic US economy, then this fund could actually benefit from the new President Donald Trump's policies to support US businesses, such as through reducing corporate tax rates for domestic producers. Baillie Gifford American, it is a volatile fund. It does give investors a wild ride, but it has seen its performance come back of late. So it puts the emphasis on identifying technology disruptors. It does have exposure to the Magnificent Seven stocks in its top 10 holdings, including Amazon, Facebook owner Meta Platforms, Nvidia, and Tesla. But it does also have exposure to other businesses like The Trade Desk, Shopify, and Duolingo. And finally, JP Morgan American, an investment trust. It holds a mixture of value and growth stocks. But also bear in mind that it does have a preference to the world's biggest technology companies in its top holdings. It holds 5 of them in its top 10. So it holds Microsoft, Nvidia, Amazon, Meta Platforms, and Apple. So, I think actively managed funds, they do give the opportunity to have quite different exposure to the S&P 500 index. But I would just bear in mind that some of them do have a decent amount of exposure to the Magnificent Seven. So I'd keep that in mind when you do wiser research. And the final question is an investment trust question. Craig, I'll give you another break on this one. You covered the pension one so comprehensively. And investment trusts are my jam and would potentially be a mastermind subject of mine. So following our recent episode on the battle between US activist investor Sabre Capital and 7 investment trusts that it had targeted, Martin got in touch to ask for an episode on how investment trusts work, including how fund managers are selected and what boards do aside from selecting the fund managers. Again, I'll certainly keep that idea in mind to do a full comprehensive episode on investment trusts. But in the meantime, I'll give a brief overview to your questions. So, as you've alluded to, it is the responsibility of the investment trust board of directors to pick which fund management company runs the investment trust. And then a fund manager that works for the fund management company will then run the investment trust. In terms of what else do the board of directors do for an investment trust? So it's their job to exercise independent oversight, hold the fund managers to account, and this includes they do have the ability to sack them if performance is not up to scratch, which does happen occasionally, although it doesn't happen as frequently as it does in football, especially in the Premier League. Boards also look after the interests of shareholders by driving down costs, and they can also consider whether the investment trust would be better off in the long term merging with another investment trust. This is particularly the case if it's got a small amount of assets and it's therefore struggling to gain wide appeal with both wealth managers and retail investors. It was actually announced on the day of this recording that JP Morgan Global Growth and Income and Henderson International Income have proposed a merger. This is subject to approval by shareholders, and if this does happen, then Henderson International Income's assets will be rolled over into JP Morgan Global Growth and Income. The current fund managers and investment objective of JP Morgan Global Growth and Income will remain the same. So that's a great example of what boards can do for investment trusts if they think it's in the best interests of shareholders. And also with investment trusts, as an investor, you're a shareholder in that investment trust and you have the same voting rights as shareholders in, say, companies. This gives you the opportunity to have your say and to exert influence. Whereas with open-ended funds, you don't get much of a say. And if you're unhappy with how the fund is investing or performing, then pretty much your only option is to vote with your feet. For me, having an independent board of directors is one of the key structural advantages that investment trusts have over funds. And we've seen recently with, as we covered in the previous podcast, so there's been an activist investor called Sabre Capital, which have been trying to introduce changes into 7 investment trusts. So what they wanted to do was they wanted to oust the boards of all 7 of those investment trusts and replace the boards with 2 directors that it had handpicked. The ultimate end game for Sabre was to manage these investment trusts and to potentially change the strategy to pool the assets together and then invest in other investment trusts that are trading on discounts. Now, at the time of this recording, we've had the votes for 6 of the 7 investment trusts, and shareholders have all voted against the proposals. And I think it's been really encouraging to see that we've seen retail investors sort of stand up and be counted. We've seen on our platform that between 69% and 76% of shares were voted across the Interactive Investor platform. And to me, this shows that when shareholders are being asked to vote on a big issue, they turn up in big numbers. And I think that's been great to see. And that's one of the advantages of investment trusts, as I've mentioned, is that you can have your say and you can exert influence. Well, that was the last question that we've got time for to cover in this episode. I'm afraid we couldn't get to all the questions, but I will keep them in mind for the next time that we do a question and answer episode. My thanks to Craig for covering off the pensions questions, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. And if you get a chance, please leave us a review or a rating in your podcast app too. You can join the conversation, ask questions and tell us what you'd like us to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website, which is ii.co.uk. And I'll see you next week.